Hello everyone and welcome to the continuation of my IFRS IAS 12 tax accounting course. In this video and going forward I will be talking about deferred taxes, and this is going to be part 1 of this series on deferred tax. You'll recall that I said that there are two elements of income tax. So you've got current tax and you've got deferred tax. And I'd spent some time to talk about current tax. So going forward, we will be focusing on deferred tax. But before I continue, I'd like to talk about accrual concepts. This course is essentially for accountants, so I expect that this is a pretty much familiar concept with us. So accrual concept is that concept that says revenue or income and expenses need to be recorded in the period that they relate to. But we know that when you calculate taxes, you are primarily calculating it on the basis of the tax legislation. For obvious reasons, the tax legislation do not care about accrual. They care about giving you the rules that you need to be able to calculate the taxes that you pay to the tax authorities. That's all they care about. And so in many cases, the principles, the laws, the legislation has nothing to do with accrual. In fact, it defeats the purpose of accrual. But because as accountants we care about accrual concept, deferred tax was introduced as a principle many years ago. And so what deferred tax tries to do is to essentially calculate an adjustment, quote unquote, that ensures that once you add that adjustment to the tax that you calculate from your tax legislation, you arrive at an overall income tax expense, as it were, that pretty much aligns with the accrual concept of accounting. And that's why you're doing deferred tax. And you remember that in the previous video I did some illustration that kinds of demonstrates why deferred tax is important. That if you did not have deferred tax, there can be material distortions in how your tax expenses are booked in the profit and loss account. Last point I'd like to mention here is to say that deferred tax calculation, based on the principles of IAS 12, needs to be on a balance sheet basis. And I'm going to illustrate that pretty soon. I'm going to switch into a spreadsheet application now and illustrate how deferred tax is calculated using the balance sheet approach. But what this principle means is that when you want to calculate deferred tax, you need to first calculate the balance as of the reporting date. So if your reporting date is 31 December 2023, you need to calculate the balance at that date. You would have calculated an opening balance, or you would have calculated the closing balance for the previous period, which is your opening for the current period. So your balance sheet approach is calculate the closing now, and in determining the movement for the period, you deduct the opening from the closing, and that's the movement for the period. That's essentially what the balance sheet approach is. So what I'm going to do now, I'm going to switch into, I use Google Sheets. I'm going to switch into, you can see the Google Sheets on your screen now. And this is essentially a snapshot of deferred tax calculation from the beginning to the end. It is a lot more complicated than this, but this is a summary that helps you to understand the A to Z in deferred tax calculation, and hopefully it makes sense to you. And once this makes sense to you, then it's a lot easier to follow the other bits and pieces I'm going to be explaining from my subsequent videos. So the starting point is this column. This column that I've labeled column A. And when I say column A, B, C now, you need to focus on the letters on the row 2. A, B, C, D, E, F, G, H, I, J, K. Yeah, so this is the first column. And this column captures your book basis balance sheet, and those are the numbers you will find in your statement of financial position, in the financial statements. And I'm sure you can recognize the items on the very first column here. So you've got PPE, you've got intangibles, trade payables, loan payables, share capital, and all that. So your starting point is to look through your balance sheet. That's your starting point. Yeah, that's the starting point of deferred tax calculation. In reality, you will have to look at your trial balance, because the trial balance is broken down into much more details than your balance sheet can capture. But that's the point we're trying to talk about. We are looking through the balances of your asset, the balances of your liability. But those are your balances from an accounting point of view. We will then need to determine or to derive a tax basis balance sheet, which is assuming you had to prepare a balance sheet, a statement of financial position from a tax point of view. What would it have looked like? It's going to look like this. Trust me, there are principles within IAS 12 that explains how to determine the tax base of an asset and the tax base of a liability. And I suspect that's what I'm going to be talking about in my next video. But for now, it's okay to know that you need to determine a tax basis balance sheet. And what that means is that you need to determine what the tax base of each of your assets are and what the tax basis of each of your liabilities are. And that helps you to derive a tax basis balance sheet. I should add here that I've had two things now. That the first thing I'm adding here is that for deferred tax calculations, we don't care about share capital, anything in equity. We don't care about it. So you don't derive a tax base for items, for components of equity, share capital. No, we disregard them completely, and that's why I've put not applicable across each item throughout this worksheet. We don't care about them. But there's something else we care about that accounting doesn't care about. There are certain items that gives you the feel of an asset that you will find in your tax returns, in your tax computations, but you will not find them in your accounting balance sheet. And so, and that takes me back to the definition of an asset. In simple terms, an asset is an item that gives you economic benefits in subsequent periods. That's why cash is an asset, because you can use cash to buy stuff. That's why a car is an asset, because you can drive a car somewhere. And in this case, for the purpose of tax, an asset will most likely, in most cases, be an item that can reduce the amount of taxes you pay in future, because that's a benefit. It's reducing your potential tax payable in future. That's clearly a benefit. But for certain reasons, those items do not qualify to be an asset in your statement of financial position. When we're doing your tax basis balance, you need to go back to your tax return to see that are there certain items that I'm carrying forward to future periods that have the potential to reduce my tax payable in future. If you have those items, then you need to bring them onto your tax basis balance sheet. And from the point of view of IAS 12, we typically will call those items carry forwards. So it can be losses, it can be assets, it can be credits. Anything you carry forward that has a potential to reduce your tax payable in future is an asset from the point of view of your tax basis balance sheet. So that's what you start from. You start from a book base, then you determine your tax base. And the next point there is to determine your temporary differences. And temporary differences are the differences between your tax base and your book base. You can see that I've done C. I've labeled temporary differences as C, and I've said that C is equals to B minus A. That's what you can see there. Simple formula: C minus A, and you drag that down. Those are your temporary differences. But then, based on the rules of IAS 12, there are certain temporary differences that aren't recognizable. I'm going to talk about these again in a much later video, to talk about what those principles are and how you can do it on your own. But for now, it's okay to know that there are principles you need to apply to determine whether you're going to have unrecognizable temporary differences. If you do have unrecognizable temporary differences, then you need to take them out. And that takes you to recognizable temporary differences. It's a simple subtraction. You do C minus D, which is temporary differences minus unrecognizable temporary differences. And that takes you to recognizable temporary differences. And the next point is which is F in this case, because I'm focusing on row 2, which is your applicable tax rate. In this case, I've assumed that it is 25%, but it will be different in your own case. It will be different in your own case, or it can be the same depending on what jurisdiction you are operating from, or what is applicable to the asset or liability. In some very strange circumstances, you can have different rates for different assets and liabilities, but it's not so common. In fact, in certain cases, you can have more than one rate on a particular kind of asset. Yeah, it can happen. In that case, you need to break down the asset into two categories to be able to apply the applicable rates. Again, I will talk about how to determine your applicable rates in a much later video. But that takes us to then deferred tax, because deferred tax is the multiplication, is a product or your multiplication of your recognizable temporary difference and your applicable tax rates. You can see the formula there. There's G equals E times F. And that's how I have computed the deferred tax asset or liability for at the end of this period. So assets are not in brackets, liabilities are in brackets. Straightforward. And again, so when you calculate your deferred tax asset or liabilities, not all assets or liabilities are recognizable. So liabilities will always be recognizable, but assets may not be recognizable. I'll talk about those principles again later from now, much later from now. But it's okay to know that there are deferred tax assets that may not be recognizable. In fact, every time you calculate deferred tax and you get an asset, you get a deferred tax asset, you must always check whether it's recognizable or not. If it's not, you do recognize it immediately. And so that's the recognition, and then takes you to your closing deferred tax asset liability. So at the end of this period, how much deferred tax asset or liability am I able to recognize? And that's what you have on your column I. And in column I is based on row 2. This row. So that's the closing for the period. So, and this is based on, you subtract your gross deferred tax asset or liability. Do that minus your unrecognizable, and that takes you to the closing balance for the period. You will have done this same thing in the previous period, at the end of the previous period. And that balance is now the opening balance for this period. And so to determine the movement in this period, a simple calculation is to say closing minus opening, and that's the movement for the period. And so in a summary, this is how you need to calculate your deferred tax asset or liability balance and the movement for the period. So what I'm going to do in subsequent video is to then talk about each of these components bit by bit, starting from tax base. So the next video is going to be focused on tax base. But to wrap up, I'd like to put a question out there. So if you believe that you understand what I've explained so far today, and obviously you're an accountant, feel free to tell me what the double entries you're going to pass at the end of this period for deferred tax, knowing fully well that this column captures your movement for the period and this column captures the balance for this period, and assume that the movement is entirely going into your income statement. So what are your double entries? Thank you, and I hope you watch the next video I'm going to post. Take care of yourself. Bye bye.